Hey there! Thanks for tuning in, Wealth Builders. Today we're going to be talking about the optimal order for investing your money because let's be real, investing can be intimidating, but it doesn't have to be. By following a few key steps, you can make the most of your investments and work towards a more financially secure future. So, without further ado, here's the optimal order for investing your money. Contribute to your employer's retirement plan. If your employer offers a 401k or other retirement plans, it's important to contribute to it as soon as possible. Retirement may seem far off, but the earlier you start saving, the more time your money has to grow through compound interest. Many employer plans also offer matching contributions, which is essentially free money. For example, if your employer offers a match of 50% up to 6% of your salary, and you contribute 6% of your salary, your employer will also contribute 3%, 50% of your 6% contribution. That's an instant 50% return on your investment. By contributing to your employer's retirement plan, you can get a head start on saving for retirement and take advantage of any matching contributions offered. It's an important step in investing for the long term, and it's definitely worth considering. By creating a budget and contributing to your employer's retirement plan, you can get a head start on saving for retirement and take advantage of any matching contributions offered. It's an important step in investing for the long term, and it's definitely worth considering. Save for emergencies. It's important to have an emergency fund to cover unexpected expenses like a car repair or medical bill. Without an emergency fund, you might have to go into debt to cover these expenses, which can set you back financially. Aim to save enough to cover at least 3 to 6 months' worth of living expenses. This will give you a cushion to fall back on in case of an emergency. It's also a good idea to keep your emergency fund in a separate, easily accessible account like a high-yield savings account. By saving for emergencies, you can protect yourself against unexpected expenses and avoid going into debt. It's an important part of personal finance management, and it's definitely worth considering. Pay off high-interest debt. If you have high-interest debt like credit card debt, it's important to prioritize paying it off as quickly as possible. The longer you carry debt, the more interest you'll pay, which can significantly increase the total cost of the debt. One way to pay off debt faster is to focus on paying off the debt with the highest interest rate first. This will save you the most money in the long run. You can also consider transferring your balance to a credit card with a lower interest rate or consolidating your debt into a personal loan with a lower interest rate. Another way to pay off debt faster is to cut expenses and put the extra money toward your debt. Look for areas of your budget where you can cut back, like dining out or subscription services, and use the extra money to pay down your debt. By paying off your debt, you can free up more money in your budget and work towards a more financially secure future. It's an important step in personal finance management, and it's definitely worth considering if you have high interest debt. Invest in taxable accounts. Once you have your emergency fund and high interest debt paid off, you can start investing in taxable accounts like a brokerage account. These accounts don't have the same tax benefits as retirement accounts, but they offer more flexibility in terms of how you can invest your money. You can choose from a variety of investments like stocks, bonds, mutual funds, and exchange-traded funds, ETFs. It's important to do your research and consider factors like your risk tolerance, investment goals, and time horizon before making any investments. One thing to keep in mind is that investing carries risk, and your investments may lose value. It's important to diversify your portfolio and not put all your eggs in one basket. By investing in taxable accounts, you can potentially earn a higher return on your money and work towards your financial goals. It's an important part of personal finance management, and it's definitely worth considering. Consider investing in real estate. Real estate can be a good investment for diversification and potentially providing a passive income. However, it's important to do your research and consider factors like location, property type, and potential returns before making any investments. One way to invest in real estate is to buy a rental property and generate income through rent payments. Just be aware that being a landlord comes with responsibilities like maintaining the property and finding tenants. Another way to invest in real estate is to invest in real estate investment trusts, REITs, or real estate mutual funds, which allow you to invest in a diversified portfolio of real estate assets without the need to buy and manage individual properties. By investing in real estate, you can potentially earn a higher return on your money and diversify your portfolio. Just be sure to do your research and understand the risks and potential rewards before making any investments. By following this order for investing your money, you can make the most of your investments and work towards a more financially secure future. And remember, investing doesn't have to be intimidating, it's just a matter of making informed decisions with your money. Thanks for watching, and make sure to subscribe so you wouldn't miss out on any new videos we post.